You may know by now that you can save up to $7,000 into a Roth IRA for tax-free growth. But what happens if you make too much? Also, what if I told you there was a way to potentially save $70,000 per year into a Roth account? Hi, I'm Ken from Voight Wealth Management, and in this video, we're going to look at backdoor Roth IRAs as well as mega backdoor Roth 401ks. If you're a high income earner who thought Roth accounts were off limits, stick around and we'll dive into this strategy for tax-free growth. First, some basics. Contributions to Roth accounts do not lower your current tax liability. However, Roth accounts will grow completely tax-free as long as you don't touch that growth until you're 59 and a half, which can significantly lower your lifetime taxes. Having a Roth account enables you to minimize taxes when you stop working, since you can cherry pick where your withdrawals in retirement come from. Roth IRAs can be opened at pretty much any financial institution, and in 2025, the contribution limit is $7,000 plus another $1,000 if you're 50 or older. The catch is, your income cannot exceed $165,000 per year if you're a single filer, or $264,000 a year combined with your spouse if you file jointly. The workaround is a backdoor Roth IRA. This simply means that you contribute to a traditional IRA, which has no income limits, and then a short time later, convert it to a Roth. So contributions are not allowed, conversions are allowed. One caveat about backdoor Roth IRAs, I don't recommend doing one if you have an existing IRA with pre-tax money in it. For example, an IRA that you roll over a 401k into. This is due to something called pro rata rules. It makes it much less attractive. But if you don't have an IRA with pre-tax money in it, then go for it. A much easier way to save money tax-free is by putting some of your employer 401k contributions into the Roth bucket. There are no income limitations, and the amounts that you can put in are much higher. Your employer will automatically stop making contributions when you hit the limit. The overall dollar limit for normal 401k contributions, traditional and Roth combined, is $23,500, plus catch-up contributions. Here's what you may not know. The IRS's limit on overall contributions to tax-advantaged accounts is actually $70,000 a year. That $70,000 includes the $23,500 for normal contributions, catch-up contributions if you're over 50, employer matching contributions, and, you guessed it, mega backdoor Roth contributions. What's a mega backdoor Roth contribution? Some employers, not all, offer a third bucket called after-tax contributions. So you'll see traditional, you'll see Roth, and then you'll see after-tax. Here's a quick example. A 50-year-old woman who makes $200,000 a year maxes out her 401k and gets a 3% match from her employer. She will contribute $23,500 normal contribution, $7,500 in catch-up, and a $6,000 employer match, totaling $37,000. If she wanted to, she could contribute an additional $33,000 only into that after-tax bucket, the mega backdoor Roth bucket, totaling $70,000. In this woman's case, she would put in 17% as a percentage in the after-tax contribution within her 401k portal. That after-tax bucket automatically converts to a Roth account shortly after the contribution. Again, there are no income limitations for doing this. Here's some key considerations. If you're fortunate enough to have that level of cash flow, it might make sense to save money inside a regular investment account instead of a mega backdoor Roth account. A taxable brokerage account is not as tax efficient. You will pay taxes on the earnings every year. However, you can access that money at any time for any reason. If you have access to after-tax contributions in your employer's 401k plan, otherwise known as Mega Backdoor Roth, that is definitely the way to go. There are no income limitations. You can contribute a lot more, and there are no pro rata rules to worry about, unlike with Roth IRAs. If your employer doesn't offer after-tax contributions, then a Roth IRA or Backdoor Roth IRA is the way to go. If you like this video, hit that like button and stay tuned for a review of 2024 stock market performance in a couple of weeks. Thank you.